Let's talk about capital gains next. Capital gains, again, I said for the most part, gets a 15% preferential tax treatment. Why did I say that? Because most folks are going to fall in these ranges. What are these ranges? Well, these ranges actually include ordinary income to determine the tax rate. So let me give you an example. Imagine if your ordinary income, let's say joint filer again, is $200,000. Let's say your long-term capital gain is $100,000, right? You sold real estate, you sold a stock or bond or mutual fund that you held for longer than a year, then that's going to be long-term capital gain. So determine the rate. The IRS actually adds these together to see which range you're in. Even though we're only talking about this piece being taxed at whatever rate it is, they're going to look at both combined to see what your tax rate is and then say, okay, they're at 300K total on these both types of income. They fall within this range of married filing jointly or even single in this case. Okay, this is a 15% tax rate on this long-term capital gain. That's how that works. Okay. Additionally, if you have losses, those can be used to offset any gain that you have in any other position. Okay. So essentially, what happens is you will offset short-term or long-term capital gains assets with losses or gains with losses as well. And you can use them to offset in the same tax year, and this can reduce your burden, right, on any gains that you had. Now, what happens if you have more losses than you have gains? Sometimes that happens. Well, you can use $3,000 of your excess loss against your ordinary income. Why does the IRS cap it at 3,000? Because the ordinary income tax brackets, the higher tax rates than the capital gain brackets at typically that 15% tax rate. So they don't want you to use the losses that you have on capital assets, right, against ordinary income at more than this $3,000 clip. So what happens if you have a loss of $12,000 at the end of the year? There's no capital gains, there's just losses. Well, essentially, what you're going to be able to do is spread out that $3,000 loss against this year. So let's call that 2025. And then you're going to then push that loss to every single year against your ordinary income, unless you have a capital gain in a future year, which would be absorbed by that. So in this example, that $12,000 loss divided by 3,000 would be done by the year 27, right? We would take three in the year 27 and it's done. Okay. That's essentially how capital losses get absorbed either against gains this year or future, or the 3K against your ordinary income and reducing that tax burden on that side. Okay. I wish I was done with this tax code, but I'm not. I've got to talk really quickly about the net investment income tax, which is an additional tax rate on assets that are capital gains, whether they're short or long, dividends, and interest. Basically, any investment asset that is not in a retirement plan gets an extra tax rate if your income, total income, is above these thresholds. So let's take that example, and that extra tax rate is 3.8%. All right. So again, guys, right? I had ordinary income for a joint filer of $200,000. Okay. I had a long-term capital gain, CG, of $100,000. Okay. We determined on that last slide that my capital gain asset is going to be taxed at 15%, and my $200,000 is going to have ordinary income tax table rates, right? We already determined that. So how do I determine the net investment income tax? Well, again, we determined that the total of both of these transactions or both of these income amounts is $300,000, right? Which means in a married filing jointly scenario, I'm above the $250,000 limit. So I'm going to take 250 off and guess what? I have $50,000 left over. And that's going to grab the 3.8% tax rate, right? And again, it would only grab the 3.8% tax rate if it was a capital gain, interest, or dividends that were over that, not just earned income from work. But if you have earnings from stocks, bonds, savings accounts, all of that, and that's over that threshold, that's where you're going to get the extra 3.8% tax on that overage. Okay. So you got multiple layers of this thing: ordinary income, capital gains, net investment income. This combines to be what your tax rate is. If, if the IRS made this simple, there would be no professions for accountants or folks like myself, correct? So it is difficult to understand. You might need to rewind this and listen to it again, but that's exactly how this goes. Okay. So the next component that I will be talking about is other tax items for you to be aware about. Okay. We just got through on that last section going through what is the current tax code system. You should have a better understanding of that, hopefully, after that section.